Great to have you all joining us here today. As you can see, we've got Nedu from Apex and Rob Weddle from Authority Brands. I thought I'd take just a few minutes to do some introductions and talk about the Home Services Summit and what we're all about. This whole event came together really because I have attended a lot of different franchise events, which have been fantastic, and other events in the franchising industry. And I consistently get messages from founders and CEOs of franchise brands saying it'd be great if we could get the home services guys together and talk shop. And so the purpose of this event and future events we'll be doing every month on the first Thursday of every month will be a webinar like this, where we bring in thought leaders and leaders in our industry to talk to us about what's happening in the home services industry. So by intro real quick, I'm Scott Abbott. I am one of the founders of 5 Star Painting. I also own a company called 5 Star Franchising. We've got a bathroom brand and a real estate brand that we're running and have been running for the last 5 or 6 years. And I'm the CEO of ProNexis, and we supply the home services industry. Our mission is all about transforming the customer experience for home service companies through voice, chat, text, and instant booking. And with me, we've got Nedu and Rob. Let me go ahead and pull up their bios real quick. I can go over that with you guys, and then we'll get into some of the Q&A. So Rob is the CEO of Authority Brands, which was founded in 2017. They're now one of the largest home service conglomerates. And in fact, they just announced the other day that they acquired Stop Restoration. So they're in the restoration business. Congratulations, gentlemen. Benjamin Franklin Plumbing is another brand. Cleaning Authority, Home Watch Caregivers, Mr. Sparky Electric, Mosquito Squad, 1 Hour Heating and Air Conditioning, and Monster Tree, which also was another deal you guys closed just about a month ago. So congratulations again. You're moving quick. Over $1 billion in revenue, which is just incredible, and well-educated. And Rob has got a lot of experience being a franchisee and now the CEO of one of the world's largest brands. We've got Nedu here as well from Apax Partners, based in New York. He's been with them since 2012. Apax Partners is a private equity partnership out of London that focuses on long-term investment and growth companies. The portfolio companies in which Apax funds employ in excess of 150,000 people and generate combined revenues of over $20 billion. Just really, mind-blowing what you guys have done and what you are doing. And with that, let's just jump right into some of the questions I've got for you. So we're gonna do about 30 minutes here where I'll lead the discussion. At 45 minutes after the hour, we'll be opening this up to all of you attending to go ahead, and you'll notice at the bottom of your screen in Zoom, there's a Q&A section. At any point in time, you can go ahead and load questions in there. I've got Will here who will help us take those questions to the 15-minute mark prior to the hour, and we'll get into those so we can get you guys interacting with us. So Rob, your story is super interesting, obviously, having moved from being a franchisee, now the CEO of a brand, and then now the CEO of a conglomerate. I'd love for you to talk to us a little about your experience and what did you love about those different parts of your career?
Yeah, Scott, thanks for hosting this. I know I'm probably one of those guys when I walk by your booth at the IFA. I know we always talk about the fact that it seems to be very focused on non-service franchisors. And so I'm glad that you were able to put this together. Obviously it's almost, this Monday will be actually 18 years to the day that I opened the doors on my first franchise business, the Cleaning Authority. And I think when I did that at the time, what I loved was that I was going to be going into business for myself, just like all of the franchisees that are out there in all of your brands. And, I think at the time thought, this is my last job ever, right? I'm going to start this business. I'm going to grow it. It's going to be amazing. I was 31 or 32 at the time, and had a young family, and it was really the dream that we sell every day to our owners. It was very successful for us. In fact, my wife and I even started looking at other companies. We attended a discovery day for Little Gym because we had a young family and thought that's the future. Where we got to take care of kids. That's gonna be a lot of fun. It didn't work out because they didn't have the territory we wanted. And then about a year later, mid 2000s, the Cleaning Authority called and said, we're putting a program together, which at the time was somewhat novel, where they were kind of starting to cherry pick the top franchisees in the system and create an operational program where we become the business coaches for the rest of the system. And that program still exists today within the Cleaning Authority. And it's something that we've actually tried to implement across the board with all the brands that we bring in. It tends to work really well from the standpoint of everybody who does well in franchising knows your best ideas as you evolve come from the people that are doing it, right? And coming from those franchisees. So the cleaning authority naturally built that into the system, and I think contributed to a lot of the great success that that business had. And I remember at the time when I was doing it, I thought this is the greatest job in the world because I'm now getting paid to do exactly what I was already doing. And I was getting better at it because I was learning from all the other franchisees in the system and collecting that knowledge and helping to build that system. So that was really, really exciting. I had an opportunity a few years later to move to Maryland and take a more senior role in the company, and that went from VP to COO, and then ultimately the founders, Steve Robinson and Tim Ivankovich, who've been franchising for nearly 20 years at that point, decided to sell the business, and they sold it to private equity. And so our first sponsor was PNC River Arch Capital. They were terrific for us, smaller mid-market firm, and really took us and saw some of the things that had been built at the Cleaning Authority and realized that we had a potential to build a platform. So for the next couple of years, we went out and we met a lot of franchisors, probably some of you that are on the call, and some of the businesses that we've acquired. I think almost all of the businesses outside of the trades that we've brought in at this point are due to some of the relationships that I was able to make over the last couple of years as we went through with PNC and with Apax, going out and meeting people and learning about their stories and learning about their businesses and seeing, are they going to be a good fit if the time comes. So I know that's a lot, so I don't know if you want to hear a little bit more, but maybe we can move over to Nedu and I'll come back and we'll start talking about authority brands after that.
Okay, yeah, but I love, your experience and how you've moved up the ranks and now are part of this amazing company. Nedu, one of the world's largest funds, billions of dollars, right? Here we are, you bought a maid services company. Tell me about that. How did you fall in love with home services?
Yeah, no, look, first off, Scott, thank you very much for inviting Authority Brands to this session and for putting it together. So, I think there's two parts to that question. I think the first piece is why TCA, right, Authority Brands. And, I'll say for us, I think it was less the maids business necessarily and more actually two objectives. One is getting access to a phenomenal management team, right? A management team that we believed could help us scale the organization as we went from 2 brands to 3 to 4 to 5 to 6, et cetera. And as we doubled, the earnings base of the business, which, actually tripled it roughly since we did the original acquisition. So a management team that could scale, right, as we intended to grow the organization. And then secondly, a platform of scale that we could build around, right, and pursue the broad thesis around a diversified home services platform. And so, with respect to, ultimately why home services, I think, in line with what you've seen over the past year or so, which is a significant uptick in terms of private equity interest in this landscape, I think there are a couple of reasons for this trend. The first is it's an enormous category, right? Somewhere around $500 billion or so of spend happens in and around the home for repair, maintenance, and renovation. So it's a massive, massive category. But importantly, it's still growing at GDP plus, right? So GDP, nominal GDP, 3-4%. From what we've seen, generally speaking, the industry tends to grow around mid-single digits. And now, of course, it's a wide range where you have some categories like restoration that are on the more mature side, so growing maybe closer to 4-5%. You have some categories like mosquito control, which is growing at double digits because it's still very much an emerging category. But by and large, I would say GDP plus, right? 5, 6, 7%. Importantly, it's extremely fragmented, which means as a participant, if you make the right investments in technology, in marketing, in customer service, you have the ability to really accelerate your organic growth trajectory, right? In other words, even though the market as a whole is growing, pretty attractively at 5, 6, 7%, you can actually meaningfully outperform that by making the right investments, just given how fragmented the marketplace is. Relatedly, right, when you think about the growth rate that it's experiencing, our perspective is that there are very few disruption risks around this category, right? So, of course, no one has a crystal ball, right? But I think if you looked out 10, 15 years out even, you'd be hard pressed not to expect a plumber to still show up at someone's home to fix a broken pipe. Now, it could be enabled, right, which we think there might be some technology enablement over time, but the core service that's being provided, around plumbing, around HVAC repair, maid cleaning, et cetera, it's really hard to see that being disrupted anytime soon. And so, for those characteristics, the size, the fragmentation, the growth, the resilience, I would say, of the broad category, and particularly COVID resistance, as we're now seeing so far this year, is why we were initially attracted to it. And as I said, we made the decision around Authority Brands, which was quite clear to us at the time, because it was a phenomenal management team and well-positioned to scale over time.
If I could just maybe double tap on that. You just mentioned COVID and how the businesses, and maybe Rob, either you can answer this question, but I'd love for you just to speak to that. How has Authority Brands performed during the COVID epidemic? Were you guys worried in March when this was coming out? Were you surprised by the results? Please go ahead and give us some background on that.
Yeah, I'll start off there. Yeah, certainly. I mean, we were just like everybody else, right? The unknown. We took some steps very early on. I mean, we did we had to furlough a few folks. We did a slight pay reduction for a brief period of time. So we really figured out where things were going. I mean, we were very fortunate that all of the businesses were deemed essential services, an oftenly misused term, but I mean, under the law, we fell under that, but that still didn't discount the fact that we're still entering people's homes, right? And so just learning how to use PPE correctly and getting over people's fears and how could it be transmitted. I mean, I remember talking to people back in March and like, oh, I've got to wash my groceries before I bring them in the house. And I think people over time realized that probably they didn't need to do that, but we didn't know, right? And so that uncertainty. But overall, I mean, we did see some interesting early on things happen. Like in the pool business, people started opening their pools earlier. We actually had the best March on record for ASP, which it leveled off a little because they didn't open them in April; they're already opened. We saw growth in some of the trade brands very quickly. The only two that brands that probably had a little bit of impact negatively in March and April would have been the Cleaning Authority and Home Watch, primarily the high touch type businesses. And we've subsequently talked to other franchisors in those spaces, and I think we were all basically going through the same phenomenon. But by and large, I think what we really also saw too was the concept of the platform and the blend and the diversification lended itself to an overall positive net gain for Authority Brands this year. So I mean, it really is, it's powerful, right? And it's, as we look to add additional businesses, I mean, it's something that we can use as a selling point to anybody that wants to join our platform. And and ultimately, our investors are happy to see that we haven't put all the eggs in one basket.
Yeah, Nedu's always smiling when he talks about Authority Brands, so there's no question that's the case. Maybe I could just jump onto this, Rob. A lot of our listeners are founders of home service brands. I'm sure some had on their mind at some point to sell. What advice would you be giving them if they were in that mindset to prepare to sell a company?
Well, first off, Scott, they should sell to us, right? That's the number one thing they should do. No, I mean, I'll tell you what, as you're building it, and I think everybody knows this conceptually, it's really to build a strong foundation, right? And like a lot of franchisors, if you're starting out where you had a really successful business, you've decided to franchise it, I would say one thing to do is look at that successful corporate location you have and ask yourself, is it representative of what I'm going to sell? Because it's disconcerting sometimes if you look at a business and you see that, the corporate store is a certain size and population or geographic population, and then they're selling franchisees that are much different. It makes it kind of tricky, right? Because you're not really representative. It's one of the great things. We do have corporate locations in a number of our businesses, and they're representative of exactly what we're selling, right? And so that's really powerful for franchise sales. We're kind of living it alongside the franchise owners, which I think is also really important. And then as you're continuing to grow, make that investment in people. Build up your staff. Figure out what it takes, and obviously founder-run businesses, it can be tricky. You as a founder know this. I mean, you have to do that. You have to give up some control. You have to train people and get ready because once the time comes and you decide to exit the business, you may or may not want to stick around. Your role might change. You're probably wealthier, and maybe you're not going to want to work 80 hours a week anymore. But if you've put the right systems in place and the right people, you're still very attractive to any investor.
Okay. Nedu, anything to add on that?
No, look, I mean, I think that's the right perspective. Not much to add, to be honest.
Okay. I'd love to just point out, because you brought up something, Rob, that it is not super common. You mentioned that you have corporate locations with a lot of the brands you guys operate. I don't know what I don't know the number, what that is in terms of brands out there that have a corporate location versus don't. I know when we had 5 Star Painting, we did not have, we started with corporate locations, but we sold them off. We had nothing that, franchisees. I know in our bathroom brand, we started with a bathroom location and we sold it off and we only have franchisees. How common is that in your network and the brands you're with? Do they all have corporate locations? Is that something you'd like to see?
At this stage, we don't have them everywhere. We've got them, and I think there's 9 brands, 6 of them have corporate locations. And yeah, I think for us, again, it's not our core focus, but having 1 or 2 units that you can use for testing, evolution. I mean, right now, a great example is the Cleaning Authority. We've had to kind of change the model up a little bit with COVID, and we've got 3 corporate locations here in Maryland. I mean, they're contiguous and basically cover the whole northern half, but we're able to use those to test products, new services, just the whole gamut. We purposely started a mosquito squad in Macon, Georgia, last year, because that was one brand that it's a great brand, but we had found that we didn't have that knowledge, and so by getting this location going, they've had a wonderful year and really proving things out. And some of the changes we've made to the marketing program and the operational structure. So yeah, I think it's a benefit. But again, it also, if you've already started, you sold it off, I don't think it's not a negative. I guess if you're a franchisor that goes into it and you've never tried to run it, right? It does get a little bit trickier, but it's probably hard for you as a franchisor to scale it up anyway, because what you're selling is theoretical as opposed to practical.
So do you have your brand presidents manage effectively the corporate franchise locations that they report up to your brand president, or do you have an operations person deal with those people?
It's all across the board. Some we've got more than 1 location, so we actually have a VP running. In another, we actually have operational support people that are managing it, and then the others, it goes right up to the brand president. But ultimately, they all do go to the brand president, so that the brand is responsible for those units. Okay.
Great. Nedu, this question's for you. So obviously the market's gotten really hot around home services. There's been some transaction. We just mentioned you guys bought Stop Restoration. You recently acquired Monster Tree, and you've been in a number of deals over the last 12 months. Shelf Genie was just recently acquired by Neighborly. And I know, we are all hearing it and seeing it. First off, and it's a 2-part question. In your mind, is now the right time to sell if you're a home service brand? And if it is, what should founders be doing if they want to improve their multiple of EBITDA?
Yeah, no, 2 very, very good questions. With the first one, I would say, look, like it's tough to know whether 2020 is the right year, 2021, 2022, etc., because you need a crystal ball, to be honest, to figure it out. But one thing that is clear is that we are certainly seeing a peak level in terms of interest in this category, right? When Rob and I, embarked on this journey 2 years ago, I would say this was a very interesting category to us, but I don't think it was as widely covered by the rest of the private equity landscape. Subsequent to that, I think you've seen a couple of new platform deals. I think you've seen a lot more activity in this space. Obviously, we've been a part of that, but some of our competitors have also been fairly active. And I think partly as a result of that, as well as broader macroeconomic factors, you've seen a fairly meaningful uptick in terms of valuations. And so certainly I think selling your business today, probably better than having sold it last year and the year before. But whether that trend sustains or reverses itself, it's hard to say. Now, with respect to the second part of the question, which is what can you do to improve it? I think from my perspective, there are 2 broad buckets of factors that influence the valuation of a business. The first is macro factors, and those typically are outside of your control, right? So it's what service vertical are you operating in, and what are the characteristics, right? Is it large? Is it recession resilient? There are some that, some categories that are more resilient than others. And there's some that are cyclical, actually. And then is the revenue structurally recurring or is it one time, right? So there are a number of aspects that I would say are just a function of the decision you made at the onset, right? Which is moving into a specific service vertical. Yeah, then there are a set of micro factors, in my opinion, that are more pertinent to the specific business you're in and that are more controllable, right? So I think revenue growth, of course, is, in my view, is the top of the list. And it's not just revenue growth, but it's what's the flavor of revenue growth, right? So how much of it is driven by same store system-wide sales growth, which is a very key important indicator, in my view, as to the strength of the network. And then how much of it is driven by franchise sales, right? Which of course is you're planting a tree, right? Which is going to grow over time and give you benefits, but is inherently a one-time proposition, right? Once you sell a territory, you're typically not going to resell that territory for a long period of time, if ever. And so, that revenue growth piece is really important. And I think we spend a lot of time when we assess businesses understanding what the trajectory is there. And so I think as a business owner, thinking about how you can drive that and make it balanced, right? So it's not just one bucket or the other, but you actually have a good mix, right? You've got a well-functioning franchise development organization that is incented to get the right sales done, right? Not just any sales, but sales where over time you see the franchisee scaling in terms of ABs and you see good retention rates, etc. But also equally that you are investing in franchise business support consultants. I think we see a whole host of different nomenclature there, but effectively consultants that are supporting your franchisees to growth and ensuring that there is a high level of same-store sales growth in the organization. So revenue is a huge chunk. I would say the other piece is to what extent is there white space, right, in the franchise system? And importantly, how have you thought about the level of segmentation of the base, right? I think we've seen examples, Rob, where there are some systems that perhaps have been too generous, right, up front with respect to territories. And so you end up having new franchisees that perhaps are not as incentivized or motivated to really sell through the territory because it's too large. In some cases, it could be too small, right, where ultimately you're not getting a good ROI in terms of your upfront investment that you're making in franchise fees. And so getting that balance right, and in some cases having the conviction, right, and the goal to actually go back and take a look at it and optimize it over time, I think is really important. And so as an owner, I think that's something that's important to take a look at and to try to optimize. There's a third piece that I guess revolves around profitability, right? And the way we view that is, are you making the right level of investments in technology, in marketing, in customer service, which ultimately have an impact on your bottom line, day one, but can bear fruit, right? And I think we've seen some systems that are definitely over margined, right, in the sense that they aren't making the appropriate level of investments in the organization to support the franchisees and to create a real enterprise, right, a real professional organization, as opposed to maybe a fly-by-night organization or something along those lines. Right. So I think understanding the profitability level that you're at and where you should be investing in corporate, in the support structure, et cetera, is super important and something that all business owners should take a look at. And then maybe on the less quantitative side, I would say one piece that's important and that we find is sometimes overlooked is just the quality of the franchise agreement, right, at the end of the day, right? Okay. So what level of contractual rights do you have in the agreement to ensure that your franchisees are adhering to best practices with respect to marketing, with respect to financial reporting, with respect to using consistent technology solutions, et cetera? Because ultimately, while it is a stakeholder-oriented business where you can't dictate or shouldn't dictate to your franchisees, it's helpful actually to have the contractual backdrop, right, as you try to convince them, on the appropriate courses of action to take. And so I think having that right structure in place and going back and taking a look at it and evolving it over time is really important. And then probably equally important is making sure that you apply it consistently, right? So that you have a franchise system that is on one royalty structure versus a whole bunch of different tiers that are in some cases preferential deals. I think that's also really important as well. And in some cases, it's actually worth going back and trying to streamline things if you didn't start out with that approach.
Lots of gems in that. Thank you, Nedu. I think hopefully our listeners are just got a checklist they've formed of all the things they need to take care of in their business. That I wish I had heard that in 2010.
Scott,
so
let me add something. It's not really,
Rob, go ahead.
It may not add to multiples, but as far as looking for the right opportunities, and it's the cultural fit. Even if you're going to look at a straight sponsor play, like our first go around with PNC, there were 10 or 11 different groups that had come in, and frankly, I think there was a few that if we had ended up there, I don't know if we'd be here today. You need to find the right partner that really has the same values as you, and then you're going to have that relationship. And we looked for that again when Apax came along, and we felt very, very comfortable with that. They were going to help us realize our vision, and clearly we have with the growth we've had over the years. And now as we're looking at other companies to bring into Authority Brands, we're very cognizant of that. Are they going to be a good fit? Our staff is really proud of them, and we started with about 5 people in management, and we've got dozens great people as we've grown. And we're over 1,000 employees at this stage of the game,
wow,
which is tremendous. So we have to be cognizant of as we're bringing a group in, are they going to enjoy what's happening, right? Are they a part of this? Are they same core values? Do they have same ideas about growth, franchise support, marketing in the businesses? And if they do, then it's going to be a whole lot easier for you.
Maybe to that point, let's talk a little bit about, and this is for either of you, sometimes a founder wants to come along and sometimes he's got an operating partner. Maybe it's a founder that doesn't want to come along, but he doesn't have a CEO or an operating partner. Do you guys have preference? Do you like to see the founder come along into the deal, or would you rather see an operating professional CEO in place? What are your thoughts on that?
We've had them all. We've had founders leave. We've had founders come along. We've had carve outs. I mean, we've kind of done the whole gamut. I mean, at the end of the day, I guess, the perfect situation is as long as there's good people. Back to my comment earlier about if you are a founder that you want to exit, or you want to have a reduced role in the business, have you prepared the management team being left behind, right? Because if you haven't, that's certainly going to affect your valuation, number one, and then probably really affect the growth of the business ongoing. So we're kind of fine with whatever works if it's the right business.
Okay. Maybe let's talk a little bit about just kind of some transactional stuff. When someone gets into the business of selling their business and they're coming to you guys, what's your experience been around how long it takes from the moment you guys sign a letter of intent to when the transaction closes, and what do you like to see happen? Thoughts on that?
Yeah, no, good question, Scott. Look, I think it again, we've done it all, right? So it really ranges from some deals on the quicker end where it's been a couple of weeks, right? We really got from start to finish really quickly. In other cases, it's been a couple of months, right? And I think ultimately it's dependent on a couple of things, right? One is how prepared the company and organization is. In some cases, we've approached certain franchise systems and founders thereof of businesses that we think are pretty interesting and would be a great fit, right, for a partnership with Authority Brands. And so in those instances, perhaps it's taking a little bit longer because you've got to have the dialogue, and then B, you've got to get them to the right level where they are able to transact with respect to all the appropriate documentation and diligence, et cetera. And then in some cases, it's been more structured, right, where the company actually is coming to market, so to speak, and approaching ourselves and others to get the deal done. So that's only one dimension. The other piece is it a carve out, or are you acquiring a standalone business? And as Rob mentioned, we've done both of those. Typically, the carve outs do tend to take longer because you've got to make sure that you get a good baseline of what the standalone earnings base would look like. One, and then two, you've got to negotiate the TSA, the transitional services agreements. And so, those transactions do tend to take a couple months sometimes, right? 1-2 months, maybe 3 months. And then, ultimately, I think there's a third piece around the nature of diligence, right? And what it surfaces, right? So, as I like to tell Rob, I've never done a deal without having some, diligence issue of some sort pop up. That's just the nature of the beast. And so sometimes when, for example, there have been, in my career, right, there have been transactions that I've done where, there's some tax issue that pops up. And so you've got to figure out how to structure around it and get the appropriate protections in place for both parties. And so that, that tends to drag on a little bit longer. But ultimately, I would say in terms of what we orient around, we've, as Rob mentioned, we've done a number of transactions. And typically we have a very good sense of the service verticals that we are buying into. We spend a lot of time thinking about where we want to be playing in proactively. And so I think from a commercial and market standpoint, we're typically able to move fairly quickly. And so it just boils down to, have we spent time with the founder or with the CEO of the company before, et cetera? And so do we have confidence around that cultural aspect? And if not, then we want to make sure we put in the time. And sometimes that happens in an instant. Sometimes it takes a couple of weeks to get to the right level of rapport. But ultimately, our goal is to move as quickly as possible and bring certainty to each transaction that we approach.
So you brought up a number of things that were important around stuff that sometimes gets in the way or slows the deal down. You mentioned a number of things. What would you say is that the biggest thing that slows deals down that you see come up almost every time? Is it the franchise agreements? There's mixed royalty rate. What do you see happening normally?
Honestly, I would say the most consistent theme actually that we've probably seen would be tax, to be honest, because I think what we found in several instances is folks will sometimes set up an S corp or maybe it's an traditional LLC, et cetera, initially, and then they transition it into being an S corp, and that tends to be much more involved with respect to the right maintenance you've got to do over time, right? The right forms you got to file, the right elections you've got to make, et cetera. And it is quite complicated, right? And so in instances where maybe there's a foot fault with respect to making the appropriate elections, then that can create some issues because you've got to make sure that you go back and correct it and that it and that both parties are protected, right, with respect to potential tax obligations down the road. And so I would say that's probably the most consistent one, to be honest, which is probably the most frustrating for us actually, because it typically has nothing to do with the people we're working with and how well we like them, or with the company and its trends and trajectory, et cetera. It's just completely exogenous and unrelated to the fundamentals of the business.
So would you advise people who are preparing their company to be sold to make sure they get a good tax attorney involved and get that stuff prepped so they know what they're dealing with? Yeah, that's good advice.
100%.
Let's talk a little bit about how you guys approach doing deals. Do you like to pay all cash? Do you like to offer equity? Does it matter to you? What does that look like in your world right now?
Yeah, look, I would say, from a financial standpoint, if you just think about the pure math of it, right, and all cash deals are typically better, right, for the sponsor and for the company, because you get 100% of the upside, right? You're not sharing any of that. You're not being diluted in a transaction. Now, having said that, typically we have done a mix of cash and stock, and that mix varies, right, depending on the size of the acquisition, the intent from the founders in the existing business. But typically, I would say, our preference is for more cash than not. Having said that, we do like the idea of including an equity component because it creates alignment, of course, between the selling shareholders and the company. One, and then two, in instances where founders join the organization and become a part of the organization leading that brand, it's very helpful to be a sizable equity owner in the business, as most of our senior management team is, because it really creates a strong incentive to solve for the greater business and a high level of alignment. And so that's why I would say more often than not we do try to include an equity component when we look at deals.
That's good to hear. I'd love to hear maybe from you, Rob, for a minute around your journey here. What was your system-wide sales, Rob, when you had just Authority Brands? Where were you guys at? A range, if you will. It's fine.
Yeah, I think when Apax purchased the business, we were nearing in on 400 million.
Okay.
With the 2 brands.
So, 400 million in system-wide sales today. You're over $1 billion. Are we approaching 2 billion? How big are you today?
Not quite 2. Probably just a little bit over 1.2.
So, that's really fast growth to have happen in just a couple of years. I think we're all envious of that kind of scale that has been achieved. What would you say would be your biggest takeaway as you've done that? If you've done the journey looking back on the last 2 years and you've achieved what you've done, what would be your, one point of advice you'd give to some aspiring entrepreneur?
Somebody that wants to do what we're doing?
Growing like you guys within their own company, hire
the right people. I think it's the number one thing. I mean, I mentioned that the executive team. I mean, we've sought out some of the best in the business in their functions, and as we brought brands on, the leaders of all of my brands, I mean, are phenomenal people. I mean, it's just it's a who's who of who in franchising, and with great experience, great knowledge. Back to that cultural fit, everybody is aligned. Everybody's kind of bought into our vision for Authority Brands, and we all work together to achieve a great end result. And I think secondly, it's having that the sponsorship we get from Apax. I mean, so finding that right partner, that's critical. And they're not holding us back, and the amount of investment that's been made in our business is phenomenal. And that's something that as we acquire companies, we're able to show them. Founders, right? And Scott, have had this conversation. As a founder, when you want to make an investment, that's coming out of your pocketbook and means a lifestyle change, perhaps. And in our world, we can make that investment, and it's okay. And so we're able to accelerate growth for those businesses that we're bringing in. Kind of do what's right, and it of course leads to good growth. It leads to great franchisee satisfaction. Just overall, you're building something that's sustainable for the long term.
Great advice there. Maybe we could just talk a little bit more about that, just in terms of how you've managed. You've got a great team, clearly. You're really proud of them. They fit the culture. In this COVID era where everyone, I can tell you guys are working from home, right? You're not all in together in person. Have you been able to manage the business really effectively, or have you found that there's been some drop in performance because you're working remotely, or any thoughts on that?
Yeah, actually, we're a little different, right? We've never brought all the businesses into Maryland. We've got a campus in Denver, a campus in Phoenix, a campus in Macon, a campus in Doylestown, Pennsylvania. We've got staff already scattered around the United States performing various functions. So we were probably a little better prepared than some organizations. And frankly, it's forced even the Maryland location where we have 85 people located, because we were all working from home, to probably become better. Really more deliberate about our interactions, scheduling ourselves a little bit more deliberately, and I feel like we're in a pretty good cadence right now.
Awesome. Okay, I've just got a couple more questions left, and then we're going to go ahead and open this up to Q&A. So we've got about 5 minutes before that happens. Feel free, all the listeners that are on the call, you've got questions, go ahead and load them into the question section. It's at the very bottom under Q&A. Will be helping us pick from that list to end the call here in a few minutes. So I know we talked about this earlier, Nedu, around the valuations, and it's kind of, but I know it's got to be a question people are going to ask. What should people be expecting around multiples for a home services company? And I know we talked about how to improve it, but what are the expectations out there right now?
Scott, I think that's probably a $1 billion question, if not maybe even more than that. Look, I would say it's a really wide range, right, in terms of what we've seen. We've seen deals that have occurred in the single-digit EBITDA multiple range. We've seen deals that have occurred in the low double-digit EBITDA multiple range. And so, ultimately, I think, the reality is the multiple will be a function of a couple of things, right? One, the macro context, right, which is what sector are you in, right? Because I think there are certainly some sectors that are perceived, whether rightly or wrongly, to be more valuable, right, from a multiple standpoint than others. And typically what drives that, as I said before, is to what extent is it fast growing? Is it resilient? Is it recurring revenue, etc.? And then the second piece, which is more company specific, is just how quickly is the company growing ultimately, right? A and B, how much white space is there, and then C, how well invested is it, right? Is it in other words, is the EBITDA base that is being sold accurate, right? Or is the buyer going to have to make a number of investments to get it to the right level, right, in terms of just professionalization and support to the franchisees and customers. And so, look, ultimately, I think all of those factors influence the multiple. And so, I think as you think about coming to market as an owner, I think it's important to understand where your business fits, across those dimensions, with respect to the nature of the industry, and then with respect to the kind of growth rate that you've achieved over the past, couple of years, et cetera, and use that as a basis, right, to set your expectations.
Maybe I could just probe a little bit further on that, because you mentioned that sometimes you're looking at a business and you find that quality of earnings is kind of what we talk about, making sure that ultimately what's been shared with you guys in terms of your EBITDA number is accurate. And you mentioned that sometimes you're having to correct that because they haven't been investing correctly or otherwise. But I'm assuming that on the flip side, that also happens where maybe someone wasn't really thinking of selling a company, but they decided this year they haven't optimized their earnings and they've got a lot of fat, in the business that could have been cut out and maybe improve their EBITDA number. Do you guys look at that as well? Does that come into play?
Yeah, no, look, that's an excellent point, Scott. Clearly, this isn't your first rodeo. You've had a few of them, right? So you know the ins and outs. But, look, I would say, yeah, it cuts both ways, right? And, I think in cases where, founders, CEOs, et cetera, are able to make a clear, reasonable case that's documented appropriately, right? That can say, hey, X amount of expense in the business over Y period of time is not really naturally recurring, right? A, or B, maybe it will be recurring, but we haven't actually seen the benefit yet, but we want some compensation for it, right? Because we've made these investments, and so it shouldn't impact the EBITDA base that we are marketing without getting some compensation. I think in those instances we're commercial, right? I think we get it, right? And we're also in the business of selling companies, right? Private equity firms. So I think we understand that math and that psychology, and it's certainly something that we work through. Okay,
great. So about one last question, and we've got a few questions coming in from our viewers. Before I go to those, we'll close up with this and then we'll go to them. So to either of you, please, what do you think are the greatest, there's a two-part question, what are the greatest risks that a home service brand is facing right now, whether it be 2020 or 2021? And, should people be looking at being part of a large organization, or do you think there's a way to just go as a solo brand and make it happen?
Nedu, do you want to take the economic question? Or
yeah, sure. Yeah, look, I would say that there are several risks, right, that pertain and impact this industry. Having said that, I think part of the reason why folks, private equity firms, family offices, et cetera, are attracted to it is because, in the grand scheme of things, relative to other categories, it's on the lower end. Having said that, I do think that given one, right, the economic fallout that we've experienced this year, I do think that a number of consumers at some point, either today, 3 months from now, 6 months from now, there will be some form of a fallout in terms of disposable income, right? And so I think you got to think carefully as to where you sit on the hierarchy with respect to the necessity of your service, right? So as an example, restoration in our view is pretty high up, right? If someone's home is flooded and it's covered by insurance, it's a pretty necessary service that's going to get purchased. There might be other ones that are either A, not funded by insurance, or B, perhaps more optional that may be impacted, right? So I think that consumer disposable income piece is important. I think there's a second piece around COVID and social distancing, where again, there are going to be some services where if it's on the more optional end of things, perhaps you'll put it off, irrespective of how much money you have, because you're worried about that dimension. And unfortunately, it seems that this dynamic is going to be in place at least for another couple of months, and possibly, hopefully not, but possibly longer. And so I think that's a second dynamic. And then I think there's a third piece, which maybe dovetails into the second part of the question, which Rob can address, which is, I do think that inherently a number of these categories across home services do benefit from scale, right? Because having more scale enables you to invest in technology and marketing and customer support and service, et cetera, which, by the way, is part of the reason why it's beneficial to be part of a franchise versus an independent business. And so I think as you continue to see large home services conglomerates, to use your words, Scott, evolve over time and grow, I do think it becomes more challenging in some cases for brands that are operating in the same service vertical as some of these larger scale franchise systems to compete, right, ultimately. And so I do think that, thinking about ways to, if you actively decide to try to grow your business and scale it, which, by the way, isn't the only answer. Some people may decide to have more of a lifestyle-oriented business, and that's the perfectly fine and reasonable place to be. But if you do decide to try and actively grow the business, then I think it's important to figure out how best to do that. And maybe it's selling to a broader, larger, more diversified business, or maybe it's seeking avenues through which you can raise capital. But I do think as the industry continues to evolve and you get larger competitors, I think if you want to continue to grow and see outsized growth, you've got to figure out ways to scale and get access to those resources.
Great, thank you, Nedu. Rob, you want to finish this off?
Yeah, no, exactly that. I think I mentioned earlier, the diversification has really helped us, with, some of the investment we've been able to make. Some of the founders that have invested in our business, they're essentially de-risking their overall investment because we're all kind of working together. I also think, some of the investments we're making on digital transformation in home services, right? Adding some complexity and sophistication to a simple business is really what home services, 2.0 is going to be all about. And it's something I think we excel at. So I think anybody that would think about their next evolution, whatever you decide to do, look for those sort of characteristics.
Great. Okay, I've got a few questions here that I'll bring up here. Just before I do, I want to go ahead and just plug our next event we're doing, as well as our annual event that we'll be doing called the Home Service Summit. This year's going to be virtual, but let me go ahead and plug December 3rd. We've got Keith Gerson from Frank Connect and Michelle Rowan from Franchise Business Review. They're going to be coming on and talking through data specifically to home services. So Keith has got some great data for us on how home service brands are scaling and selling franchises. I've seen this data before in franchising in general, whether it's brokers, whether it's internet marketing or trade shows and so forth. They're actually taking this out, find the best practices among just home service companies and giving us that data for franchise sales. And then Michelle Rowan does a lot of feedback from franchisees to franchisors, independent research on franchisees. And she'll be speaking to what home service franchisees want out of their franchisors, what we're seeing in that data. So it'll be December the 3rd at 1 p.m. Eastern. You can count on a webinar like this every month on the first Thursday of the month at 1 p.m. And then lastly, we have our first event that will be on February 4th and 5th. If you go to homeservicessummit.com, you can see a lineup of some of the speakers we have scheduled already. It's going to be a lot of hyper-focused content just for home services, this kind of conversation we're having here around, acquisition, selling a company, as well as what's working in sales and so forth. I welcome you to go ahead and register for that. Now, Will has gone ahead and put into the chat the link you can hit if you want to register for that event, okay? And lastly, before you sign off, if you don't mind, I'd love feedback. So if you found this has been a great event and you appreciated it, please let me know. All I'm looking for is a scale of 1 to 10, how you'd rate it. And if you've got comments in terms of how we can improve, please offer that to us. So with that, I'll jump into some of these questions that have come up. Barry Falcon. Hi, Barry. Great to have you on the show. From iFranchise Group. Barry, congratulations on your sale of Shelf Genie. Well done. His question is, when planning an exit, when is the best time to advise the Franchise Advisory Council or franchisees?
Well, we haven't actually advised the franchisees until the sales were completed in the past. I mean, the businesses we bought, I know, haven't done it until they've been completed. And our last pass, when we sold to Apax, we didn't advise the franchisees either. Now more internal staff know about it. So I guess it maybe depends on how many times you've gone through the process, because obviously, again, it could potentially spread fear over the unknown before things are really drummed out. And so yeah, I guess it would be after transaction.
Do you do any more context?
Look, I agree with that perspective, because ultimately I think you want to guard against fear, confusion, misinformation, etc. And so it's better to keep potential transactions discreet, confidential, until you've got a signed binding agreement. And so in our experience, that's been the approach that's been most consistently applied in the processes that we've been involved in.
Maybe to that note, did you have the founder or the owner go ahead and announce that to the franchisees themselves? Was it a joint announcement? Did you do a web conference? How did you go about letting everyone know that the deal's done?
We just did it this week, right? So we've got a pretty good communication cadence at this point, where we notify our internal staff, all of our existing franchise owners, and then the new business, the founder or executives will send a notification, quickly followed up by notification from us, from myself, and then typically that leads to an invitation to a town hall, which we'll hold virtually at this point. And then depending on when their annual meetings or regional meetings are, we'll attend those as well. So we've kind of done it all across the board. But I guess the point being, we're getting out in front of it as quickly as we can, making ourselves accessible. We set up inboxes for all the new companies for people to submit questions and concerns, and we end up in a lot of one-on-one conversations with people, just so they can understand the vision and how things might change. And I think most people are pleasantly surprised that the stuff they really love isn't what's going to change, right? That's not why we would get into a transaction. And the stuff that maybe they don't like, they want to know, how are we going to change it? And so we kind of focus on those areas. And really trying to find 1 or 2 big wins in the first 90 days is really critical. And we'll work on that during the diligence process to see where can we add value very quickly into the organization.
Great. Thanks for that, guys. Another question here from Kim Caps. Kim, great to have you on the show. Thanks for joining us. How typical is it to have revenue workout component as part of the valuation process, do you find? And if a workout arrangement does exist, what are the typical timeframes?
So I'm going to assume, Scott, that means an earnout.
Yeah, I think the more well-known word for that is earnout. Correct. Yep.
Yeah, makes sense. Yeah, look, I would say we've done it in the past. I think our general view is we'd prefer not to, because it creates complexities with respect to integration after the acquisition is initially done. And then also, in some cases, there could be misalignment, right, between the brand president, if it's the former founder, or between the company, right, and the employee, right, in the instance where the founder is coming with a business. And so, typically what we've done historically when we have done it is to shorten the time frame, right, to keep it closer to 1 year versus, in theory, it could go out longer than that, but we try to shorten it as much as possible. And then secondly, we try to bridge any potential valuation gap in other ways. Some of which are trade secrets that we wouldn't discuss, but others of which are really just through selling the business on the benefits ultimately of being part of Authority Brands.
Great, thank you for that, Nedu. So I've got a question here from Bob Lewis. Bob, thanks for joining us on the show. It seems to me that an upcoming challenge is going to be to determine how much of the current elevated demand level is being pulled forward by COVID impact. Any thoughts on what the trend line is post-COVID? So I think maybe I think I understand this question. I mean, we've seen, I know, a bathroom brand, we're up 100%. I think since June, July, August, September, October, every month, we're up 100% over prior year. I think there's an observation that there are some people just cooped up in their houses and they want to get stuff done and they're calling more than they would. I'm curious if you guys feel like post-COVID, when it's done, are we going to see a slowdown because they've spent their money, or do you feel like, no, it'll just keep going?
Yeah, I don't necessarily think so. I mean, we're really not in the improvement business. I mean, we are doing replacements in like HVAC units and electrical and plumbing, but by and large, I mean, we've also seen more people go to repair, right, to extend life. So I don't really think it's impacted our existing businesses. Now, it doesn't mean there aren't other businesses, and your example is perfect, right? I do believe there's people, many of us have, spouses at home that might be doing this, and wow, I want that fixed finally, and they get it done. So certainly it can happen. We've heard about it, but I don't think it's a big thing for us.
Yeah, I think maybe just from my experience, I think, Bob, to this point, I think that for our brand, we're definitely thinking about it, right? And our goal is ultimately just to get in front of it by getting really aggressive with our marketing and taking market share, so that when there is a slowdown, we've got a bigger customer base to pull from and ultimately get the right sales channels in place so that we don't experience as much of a slowdown as maybe someone else would post-COVID. I got another question from John Keene. John, thanks for joining us. His question is, all things being equal on the financials, what types of things make one franchise brand more valuable than another?
Yeah, so I can take that. Look, I think part of it, as I said, alluded to a little bit, I didn't explicitly say, but I think part of it ultimately is the perceived quality of revenue and the riskiness of that asset, right? So you have two businesses with the same growth profile, the same margin profile, which I think was what was alluded to in the question. And the question then becomes, okay, well, first off, is it recurring revenue or one time, right? Which is not necessarily evident in the financials, right? But if it's more recurring, that certainly makes it more valuable, right? The second question is, irrespective of whether it's recurring or one time, how has this industry performed in prior recessions? Is it a typically recession resilient business or not, right? And in our experience, categories like restoration, as an example, have been recession resilient because ultimately it's a non-discretionary need and it's paid for by insurance. And so in prior recessions, we've seen many players, if not most of the players, grow through that recession. So I'd say that piece, which speaks to the riskiness, right, of the revenue or the earning stream, would make it more valuable than less. And then I also think the growth rate of the overall industry is important because you could have a company that is growing significantly faster than the rest of the industry, which you could argue may be harder to sustain over time than an industry that perhaps is growing in line with the rest of the industry, but which means that you could potentially accelerate that trajectory, right? And so, I think the growth rate of the company with respect to the broader industry is also quite attractive. And generally speaking, the faster the industry is growing, the better it is, right? For any given asset. So great. Hopefully that gives a good sense.
That was great. Thanks, Nedu. I got one last question and we're going to close off here. And before I ask it, I'm going to go ahead and just thank you both once again, Nedu and Rob, for joining us. I want to thank all of our listeners who have joined us and those of you who have asked questions. We hope this has been valuable to you, and I hope that you join us again. Last question, which you're open to answer if you'd like, and this may be confidential, but whatever you're willing to share, we'll take it. The question was, how much total capital, debt and equity has been deployed by Apax?
Let's just say it's hundreds of millions and leave it at that.
A lot. Okay, great. Thank you, gentlemen, again. Great to have you on the show, and we'll catch up soon.
All right. Thank you, Scott.